The unthinkable is about to happen to gold and silver, and the trigger isn't the Fed, it isn't inflation, it isn't some war nobody saw coming. The trigger is AI. Yeah, the same AI that is making every tech bro on your timeline rich on paper. Right now, I know that sounds backwards. The hottest trade on the planet is quietly setting up the oldest trade on the planet for the move of a generation. And before you close this thinking I'm some gold bug living in a bunker, I'm not. I own tech. I own a ton of it. But I also look at numbers for a living, and the numbers I'm about to show you kept me up 2 nights in a row. Gold and silver, adjusted for real dollars, are sitting near 50-year lows in terms of how cheap they are relative to stocks. And at the exact same time, the AI boom is quietly building the kind of pressure that historically only ends one way. If you own an index fund, a 401 kilobits, any big tech name at all, you are already sitting on one side of this trade, whether you picked a side or not. So the only question that matters for the next 30 minutes is simple. Are you going to be on the right side of it when it flips? Before I get into the details, I need you to do one thing for me, and I'm not going to be shy about asking, hit subscribe right now before you keep watching, not after. What I'm about to walk you through is the kind of research that hedge funds pay analysts 6 figures a year to produce. I'm giving it to you for free because I think more regular people should understand how money actually moves before it moves, not after. So subscribe, turn on notifications, and let's get into it, because this next part changes how you look at your entire portfolio. Let's start with what actually happened, because on their own, none of these things look like a big deal. That's the trick. That's how bubbles always work. Nobody points to one single event and says, there, that's the moment. It's always a stack of smaller things that only look obvious in hindsight. So I want to walk you through this stack, piece by piece, the way I'd walk a business partner through a deal that smelled a little off. First thing, NVIDIA, the biggest company on earth by some measures, arranged something like $100 billion, maybe more depending on the week you're reading this, in financing deals with the very companies that turn around and use that money to buy NVIDIA's chips. Think about that for a second. NVIDIA helps fund the customer. The customer buys from NVIDIA. NVIDIA books the revenue. The stock goes up on the news. Everybody claps. That's not a conspiracy theory. That's public information. It's in the filings. When I was building companies, we called that channel stuffing. If you were being generous, and we called it something a lot less polite if you weren't. It's not illegal, it's not even necessarily wrong, but it is a sign that the growth story needs help standing up on its own legs. Second thing, and this is the one that actually stopped me, at the very same time everybody's celebrating record highs, the cost of insuring against an NVIDIA default, that's the credit default swap market, quietly doubled. Now, here's why that matters more than the stock price. The stock market is driven by sentiment. People who like the story, people who want to believe. The credit market is driven by people whose entire job is figuring out who doesn't get paid back. Bond traders don't care about vibes. They care about cash flow and collateral. And when the people whose job is to worry about default risk start paying twice as much to protect themselves, that's not noise. That's the smartest, most boring, least emotional money on the planet, quietly raising its hand and saying something feels off. Here, I've built and sold companies, I've sat across the table from bankers who priced risk for a living. And I promise you, those people are never early to the party and they are never wrong for long. Third thing, the biggest tech companies on earth, the ones sitting inside your retirement account, whether you know it or not, are about to spend an amount of money on data centers and chips that genuinely doesn't have a clean historical comparison. We're talking hundreds of billions of dollars a year. Some estimates put the combined capital spending from the handful of biggest AI players near $1 trillion over the next couple years. To put that in perspective, that's more than most countries spend on their entire military, and a huge chunk of that spending isn't coming out of cash sitting in the bank. It's coming from debt, new debt freshly issued specifically to build data centers that need to generate a return before that debt comes due. That is a bet, a big one. On demand for AI computers continues to grow at a pace that, frankly, Nothing in economic history has ever sustained forever. Now here's where it starts connecting to gold and silver. So stay with me. All of that spending needs power, real physical electricity. Data centers eat electricity at a scale that is starting to strain actual power grids in actual states. Utility companies are scrambling. Some of them are even talking about firing up natural gas plants and, in some cases, delaying the retirement of coal plants just to keep up. When you have that much demand hitting a grid that wasn't built for it, energy prices go up. And when energy prices go up, that shows up everywhere else in the economy. From what it costs to ship a pallet of goods to what it costs to manufacture pretty much anything, that's inflation, plain and simple. And it's inflation caused not by too much stimulus money floating around, but by an actual physical resource constraint. The Fed can't print more electricity. The Fed can't print more transformers or turbines. And by the way, there's a real shortage of those too right now. So you got a scenario where a technology boom, the thing everyone thinks is deflationary because it makes workers more productive, might actually be quietly inflationary in the near term because of what it takes to build the infrastructure underneath it. And there's a fourth thing I almost forgot to mention, and it's the one that ties this whole stack together in a bow. Look at who's actually lending the money for a lot of this data center build out. It's not always traditional banks anymore. A growing chunk of it is coming from private credit funds, the same corner of the financial system that's grown enormously over the last decade with a lot less regulation and a lot less transparency than the banks you and I grew up dealing with. When I ran companies and needed capital, I dealt with banks, and banks had regulators crawling all over them, stress testing them, forcing them to hold capital against bad outcomes. Private credit doesn't have nearly the same level of oversight. So you've got a mountain of debt. Some of it's stacked in a part of the financial system that's harder to see into. Funding a technology bet that requires years of sustained demand growth just to break even, let alone turn a profit. That's not me saying it's going to blow up tomorrow. It's me saying, as somebody who just spent 30 years reading balance sheets, that this is exactly the kind of setup that makes smart money quietly build a hedge, even while publicly staying bullish on the technology itself. Let's talk numbers for a second, because I don't want you just taking my word on faith. Global data center capital spending, according to multiple industry estimates, is on pace to roughly double from where it's at just a couple years ago, pushing toward the $1 trillion mark annually across the biggest players combined. Electricity demand from data centers in the United States alone is projected by several utility and grid operators to potentially double or even triple over the coming decade. Some regions, places like Virginia, where a huge concentration of data centers already sit, are already seeing utilities warn about capacity constraints. That's not a hypothetical future problem. That's a problem today, showing up in filings and Public Utility Commission hearings right now. When physical infrastructure can't keep pace with demand that fast, prices for the underlying inputs, power, cooling equipment, transformers, copper wiring, and yes, silver, go up. It's basic supply and demand, the kind of thing you learn in the first week of any economics class, except most people aren't connecting the dots between their AI stock portfolio and the price of a physical commodity sitting in a vault or a mine somewhere. Now let's talk about why gold and silver specifically sit right in the middle of this. Starting with gold. Gold has one job historically, and it's done that job for about 5,000 years. When people stop trusting paper promises, whether that's a currency, a bond, or a stock certificate, they go back to the one thing that doesn't need anybody's promise to be worth something. It's not a company. It doesn't have earnings calls. It doesn't have a CEO who can lie to you. It just sits there, and for thousands of years, humans have agreed it's worth something. Central banks around the world have figured this out faster than regular investors have. They've been buying gold at a pace we haven't seen in decades. Quietly, methodically, central bank after central bank, especially outside the US, loading up on physical gold and, in some cases, actually moving it out of foreign vaults and back onto their own soil. That's not a trade a central bank makes because they think gold is going to pop 10% next quarter? That's a multi-decade positioning move. That's a country basically saying, we don't fully trust the current system to hold up. So we want an asset in our vault that doesn't depend on anyone else's promise. And here's the part that really gets me. Even with all that central bank buying, even with all the headlines about gold hitting new highs in nominal dollar terms, when you actually adjust gold for inflation, for what a dollar actually buys today versus 50 years ago, gold is still nowhere near its real historical peak. We are talking about an asset that, relative to the size of the stock market, relative to global GDP, relative to the total amount of money sloshing around the system, is historically cheap. Not expensive, cheap. The narrative in the financial media is gold's at all-time highs. You missed it. The math says something completely different. I've made a career out of buying things the crowd has already decided are boring. And let me tell you, boring and cheap is a combination I pay attention to every single time. Think about it this way. Right now, the combined value of every ounce of gold ever mined in the history of the human race is still smaller than the value of just a handful of the biggest tech companies on Earth. Let that sink in. Every wedding ring, every gold bar sitting in Fort Knox, every coin in every central bank vault on the planet, all of it combined is worth less than a few tech stocks. I'm not saying gold should be worth more than big tech. I'm not that guy. But when you see a mismatch that lopsided, it tells you something about where the crowd's attention has been for the last 15 years. And attention like that doesn't stay in one place forever. Money rotates, and it always has. I've watched it happen in real estate. I've watched it happen in tech. I've watched it happen in commodities. And I promise you, I'll watch it happen again. And here's something most people miss entirely. The ordinary retail investor, the person watching this video right now, actually owns almost none of it. Gold, as a percentage of total global financial assets, sits at a tiny sliver compared to where it's historically sat during past periods of uncertainty. Most people's entire exposure to gold is zero. Not 5%, not 2%, zero. Which means if even a small rotation happens, if pension funds and institutional money simply move their gold allocation back toward historical norms, that's an enormous wall of money chasing a relatively small, relatively illiquid market. That's not speculation. That's just math about how much money would need to move and how little supply exists to absorb it. Now let's get to silver, because silver is where this whole AI connection gets really interesting, and I don't think enough people are talking about it. Silver isn't just a shiny metal that sits in a vault looking pretty. Silver is an industrial metal. It's one of the best conductors of electricity on the planet, better than copper, and it's used in an enormous number of the exact things this AI boom needs to keep expanding. Solar panels use silver, electric vehicles use silver, and a huge amount of the electronics inside data centers, the servers, the cooling systems, the power delivery systems use silver too. So think about what's happening right now. You got a global build-out of AI infrastructure that needs massive amounts of electricity, which is accelerating solar and renewable build-out, which eats more silver. You've got EV production continuing to scale, which eats more silver. And you've got the data centers themselves packed with electronics, eating more silver at the exact same time. Above-ground silver stockpiles have been shrinking for years, and new mine supply hasn't kept up. Because frankly, most of the world's silver doesn't even come from dedicated silver mines. It comes as a byproduct of mining for other metals like copper and zinc. You can't just flip a switch and mine more of it when demand spikes. So you've got rising industrial demand colliding with the supply chain that moves incredibly slowly. And on top of all of that, silver still carries its old job as a safe haven too. Just like gold, just a smaller, more volatile, more explosive version of it. That's what makes silver different from gold in this story. Gold benefits mostly from fear, from people losing trust in paper promises. Silver benefits from fear and from actual physical demand tied directly to the thing everybody's obsessed with right now, which is AI and the electrification of everything around it. That's a double engine. And historically, when both of those engines fire at the same time, silver doesn't move like gold moves. Gold might go up steadily. Silver has this habit of sitting there quietly, looking boring, looking forgotten, and then moving in a way that makes people who ignored it feel like they missed the easiest trade of their life. I've said this before in other videos, and I'll say it again here because it matters. Silver has historically been called poor man's gold, and honestly, that nickname undersells it. When silver moves, it tends to move faster and further than gold in percentage terms, in both directions, up and down. That's just the nature of a market that's smaller and less liquid than gold. Less money is needed to move the price meaningfully, which is exactly why, when institutional money does start rotating in, even a modest dollar amount relative to what moves, gold can send silver on a run that looks almost violent compared to how it's traded the last several years. Add in the fact that industrial buyers, the solar companies, the EV manufacturers, the electronics makers can't just wait around for a better price the way a retail investor can. When a factory needs silver to keep the production line running, they buy it, price be damned, because the alternative is shutting down the line. And that kind of inelastic must-have demand colliding with a shrinking above-ground supply is exactly the setup that's produced silver's biggest historical moves. There's also a supply story here that doesn't get nearly enough attention. Roughly 3/4 of the world's silver doesn't come from primary silver mines at all. It comes as a side product from mining copper, lead, and zinc, which means mining companies aren't sitting around deciding to ramp up silver production when the price goes up, because that's not really how their business works. They're mining copper or zinc because that's the primary economic driver of the project, and the silver just comes along for the ride. So even if silver prices spike hard, the supply response is slow, sometimes years slow, because you'd need entirely new copper or zinc projects to come online just to get more silver as a byproduct. That's a structurally sticky supply chain sitting underneath a demand picture that's accelerating in multiple directions at once. So let's put the whole picture together, because I want you to see how these pieces actually connect. Instead of just taking my word for it, you've got a handful of the biggest companies on the planet borrowing enormous sums of money to build out AI infrastructure at a pace that has no clean historical comparison. You've got early warning signs in the credit markets, the boring, unemotional, extremely well-informed part of the financial system, showing real concern about how some of that debt gets repaid. You've got an enormous physical demand for electricity that's straining grids and quietly pushing energy costs higher, which pushes inflation higher in a way that has nothing to do with government stimulus and everything to do with actual physical scarcity. And in that exact environment, historically, one of two things happens. Either the AI build-out delivers on its promise fast, enough to justify the spending, in which case you get a genuinely inflationary boom because of how much raw material and energy gets consumed doing it. Or some of these bets don't pay off fast enough, credit gets tighter, some of that debt gets called into question, and markets get spooked. Money rotates hard and fast into the safest, oldest stores of value that exist. Either path, inflationary boom or credit scare, tends to be very good for gold, and because of that extra industrial kicker, potentially even better for silver. Now, I want to be straight with you because that's how I do business and it's how I do these videos. Nobody, not me, not the smartest hedge fund manager on Wall Street, knows exactly when this plays out or exactly how big the move is. Markets can stay irrational a lot longer than any of us expect. And I've been burned before by being early on something that turned out to be right eventually, but painful in the meantime. This isn't a guarantee, it's a setup. It's a situation where the risk and reward looks lopsided in one direction based on the actual numbers, not based on hype, not based on some guy yelling on the internet. And by the way, I did put real money to work recently, a stock position I mentioned at the top of this video that plays into exactly this shift. And I'll get into the specifics of that one at the very end. So stick around for that. And especially if you're more of a stock person than a physical metal person, because there's more than one way to play this. So here's my challenge to you before you go anywhere else today. Go open up your 401 kilobits, your brokerage account, whatever you've got, and actually look at it. Not a quick glance. Actually look. What percentage of what you own is tied directly to the AI trade, whether that's the chip makers, the cloud companies, the index funds that are secretly stuffed with the same 5 or 6 mega cap names? And then ask yourself, honestly, do you have anything at all sitting on the other side of this? Something that does well if the story gets bumpy instead of only doing well if the story goes perfectly. Most people, when they actually do this exercise, realize they're way more exposed to one single outcome than they ever meant to be. That's not a reason to panic and sell everything tomorrow. It's a reason to get educated, ask better questions, and make decisions on purpose instead of by accident. If this video actually made you think differently about your portfolio, do me a favor, hit subscribe if you haven't already, drop a comment telling me whether you're more worried about the AI side or more excited about the gold and silver side. I read every single one, and go check out the next video where I break down the exact stock position I bought and why. I'll see you there.